Assalamualaikum warahmatullahi wabarakatuh. My name is Faqihah Binti RIDZAN as Presenter 1.
Hi, Assalamualaikum warahmatullahi wabarakatuh. My name is NURAISHAH binti ROSLI and I'm from JBC 2423B.
Let's take a look what is translation exposure. Exposure, also known as accounting exposure, where there is a risk having changes in foreign exchange rate trigger losses on business transaction or balance sheet. These losses can occur when a firm has asset, liability, revenue, and equity denominated in foreign currency and is usually found at multinational company. Therefore, financial statements are consolidated in domestic currency. Consolidated financial statements are the combined financial between parent company and its subsidiary. Translation exposure happens when a company has subsidiary located in other country and a business engaged in significant sales transaction in other country. For the first method is current or non-current method. Current asset and liability having a maturity of 1 year or lesser are translated into current exchange or spot rate. The equation given, company XYZ has subsidiary in euro. So, the cash given in euro, so we convert it into domestic currency, which is the answer $2,875. For non-current asset and liability are converted at the historical exchange rate that prevailed at the time asset or liability was recorded in the book. Since long-term debt is non-current asset, we multiply by historical rate given, so the answer is $4,000. So, under this method, a foreign subsidiary owning current asset in excess of the current liability will occur a translation gain if local currency appreciate. For the second method is monetary or non-monetary method. For all monetary balance sheet accounts such as cash, account payable, not payable, and market security of foreign subsidiary are converted at the current exchange rate or spot rate. For example, we calculate cash because it's one of monetary, and we multiply by spot rate given, so we got the answer $2,875. For the remaining non-monetary balance sheet accounts such as fixed asset, inventory, and shareholder equity are converted at the historical rate. For example, we calculate equity and multiply by historical rate given, and we got $5,120. This method works on the philosophy that monetary accounts are similar as their value is equivalent with the amount of money. The value of which changes with fluctuation is exchange rate. The monetary or non-monetary method categorize account on the basis of similarity of attribute rather than maturity.
I will continue the method of translating the balance sheet. For the third method is temporal method. It is relating to time and is similar to monetary or non-monetary method. For monetary account, both current and non-current are converted at the current exchange rate, which is spot rate. In the table, show that cash, inventory, current liabilities are converted at the current exchange rate, which is spot rate. Formula value in euro times with spot rate, which is 1.15 USD. However, if they are carried out in the past, they are converted into the historical rate of exchange that prevailed during that time. In the table, show that net fixed asset, long-term debt, equities are converted at historical rate, and the formula is value in euro times with historical rate, which is 1.6 USD. For more information about the temporal method where asset and liabilities are classified into monetary asset and liabilities and non-monetary asset and liabilities. Monetary asset and liabilities are those that are to be settled in the future through receipt or payment of predetermined unit of currency. Monetary items include cash, account receivable, notes receivable, investment, account payable, salaries payable, taxes payable. And for non-monetary items include inventories, fixed assets. Further, under the temporal method, income statement items are converted at the average exchange rate, and any foreign exchange gain or loss under the temporal method is recognized as a line item on income statement, and common stock and others equity items other than the retained earnings are converted based on historical exchange rate.
The last method of translating the balance sheet, which is current rate method. Current rate method, very simple method in application, and the table shows that all balance sheet item except for stockholders' equity are converted at the current exchange rate, which is spot rate, equal to 1.15 USD, and a plug equity account named Cumulative Translation Adjustment (CTA) is used to make the balance sheet balance, since the translation gain and loss do not go through income statement according to this method.
Hedging translation risk. A variety of mechanisms are in place that allow a company to use hedging to lower the risk created by translation exposure. Companies can attempt to minimize translation risk by purchasing currency swap or hedging through future contracts. In addition, a company can request that clients pay for goods and services in the currency of the company's country of legal residence. This way, the risk associated with local currency fluctuation is not borne by the company, but instead by the client, who is responsible for making the currency exchange prior to conducting business with the company. In addition, translation exposure can be managed by employing a balance sheet hedge strategy. A balance sheet hedge is where a company matches its asset in foreign currency X with equal amount of liabilities in the same foreign currency, such that its net exposure in each currency is zero. It is because a movement in foreign exchange rate changes the value of both asset and liabilities, such that net translation effect is zero. A company should consider the cost of borrowing in each currency before attempting a balance sheet hedge. Managing translating exposure. Firstly is currency swaps. Currency swaps are a settlement between two entities to exchange cash flow denominated for a particular currency for a fixed time frame, and currency amounts are swapped for a predetermined period, and interest is paid during that time span that will help manage risk. For the second way to manage translation exposure is currency option. The currency option gives the right to the party to exchange the amount of particular currency at an agreed exchange rate. However, the party is not obligated to do so. Nevertheless, the transaction must be conducted on or before a set date in the future. And the picture shows that for call option, whereby the prediction of price is increases, while for the put option, the prediction of the price is decreases.
Lastly, forward contract is one of managing translation exposure. It is two entities enter into a contract with each other of the specific exchange rate for settlement of transaction on fixed date in the future. Next, all forward contracts are predefined in all aspects, which manage the risk of fluctuation in the exchange rate but still involve speculation. Other than that, the settlement for the agreed amount of currency is conducted on a particular future date which is pre-decided. There are some advantages and disadvantages of forward contract. The advantages of forward contract is it can be matched with the exposure time period as well as the exposure case size, and it provides a complete hedge. Forward contract is over-the-counter product. If we use forward contract, it will provide price protection, and the forward contract is easy to understand. For the disadvantages of forward contract, capital funding is required. Before settlement, there are no intermediate cash flow and is subject to default risk. Forward contract can be difficult to cancel and it's also difficult to find a counterparty. For the settlement of forward contract, there are two ways, which is physical delivery and cash settlement. For physical delivery, the long pay the agreed upon price to the short and receive the underlying asset from the short. And for cash settlement, the buyer receive the difference between the market price and the agreed upon price. If the market price is higher than the agreed upon price on the date of settlement. The cash settled forward price is also known as non-deliverable forward, which is NDF. The conclusion for this topic, this translation exposure is inevitable for companies operating in other countries than their home country. It is usually a legal requirement for regulators because it doesn't change cash flow but only change in the reporting of consolidated financials. The translation done on time of reporting but not at the time of realization. Therefore, it will resulting in national profit and losses. Lastly, this type of exposure will poses a threat at the time of presenting unpredicted figure or financial statement in front of shareholders, which might result in question for the management of the company. This kind of scenario have happened many times due to fluctuation in the foreign exchange rate and considered normal. That's all from me. Thank you.